Hi traders, welcome to my YouTube channel The Mighty Bull. Today I am going to discuss one of the most important yet boring at the same time. The topic is none other than the position sizing strategies. But at times in life, boring activities is what leads to exciting outcomes. For example, learning geometry might be boring, but it leads to architectural marvels, the bridges you see, and even the spacecrafts. Similarly, learning coding might be boring, but it leads to the exciting outcomes like your gaming app, artificial intelligence like ChatGPT and Gemini, or even the food delivery app and shopping apps you use daily are a result of boring thing that is coding. Similarly, if you note, the position sizing might be boring to read, but the outcome it gives will be exciting. That is, you will have a long trading career with success and it will lead you to wealth creation. Before proceeding, I would like to tell why it is important to learn position sizing strategies. If you know the why, it will be very easy to learn about how, right? Because the position sizing strategy tells you how many shares you can buy at a given time, how to manage a trade and mitigate risk, and also reduce drawdowns in your portfolio. But still, it is the most neglected thing in the trading journey of an individual. Why? The more focus is given to the strategies, the moving averages or indicators, but this one thing is being neglected a lot. Improper position sizing will give inconsistent results because sometimes you might be over invested in a stock, which will lead to increased risk, or at times you will be under invested in a stock, which will lead to lesser rewards. So in this video I am going to discuss about 4 types of position sizing strategies that was discussed by Tharp in his book Trade Your Way to Financial Freedom. I will be discussing each of these in a simple and more brief way so that you can understand them easily, and at the end of the video I will also tell which one is more important and how you can use it for your trading journey. The first is the model 1 called as 1 unit per fixed amount of money. This is the simplest method and at the same time it is rudimentary because it has the highest return but also has the highest risk potential. It is very simple. For example, if you have an account size of about 10 lakhs, what you do is you invest the entire amount in a single stock. Literally you are putting all your money in a single basket. But what will happen, even though it is possible that the stock will run up and you will get a higher return on your entire portfolio account, it is highly possible that the stock may gap down immediately, or even if it's a stop loss, what you will do, imagine the stock gaps down, the next day you buy the stock to 20%, you will lose 20% of your account value, right? So always risk management is the first thing to do in trading. So this method is highly rudimentary and it is not advisable. So this method should not be followed. We need a better method. Then comes the second model, which is a little bit better, that is equal value units for stock traders. Here you divide your entire capital into equal segments and deploy. For example, if you have an account size of about 10 lakhs, what you do is you equally divide them into segments and deploy them. Here the account of 10 lakhs is divided into 1 lakh and invested in 10 different instruments or 10 different stock at the same time. So you invest around 10 lakhs and by dividing them equally. But this also has many disadvantages. The first one I will explain with a table. You can see in this table, imagine a trader who is having a portfolio value of about 1 lakh. What he does is he divides this 1 lakh into 10 equal parts, that is he invests 10,000 in each of the stock and he buys 10 stocks. So he buys 10 stocks with each investment of around 10,000. So totally he has invested all his 1 lakh by dividing them equally. Now after a period of time, the current value changes depending on the profits and loss. He generates 5 winning trades and 5 losing trades for theoretical purpose. In the first trade, he has garnered around 18,600 as current value. That is, he got around 86% of gain. So his current value becomes 18,600. And in the sixth trade, you can see he is having the largest loss of about 35%. and his current value has become 6500. So after a period of time, the current value has changed consistently, even though the invested value at the time of investment were remained same. So according to this position sizing strategy, what you should do is you should balance this amount here in the current value. That means you have to sell the stock one which has given a highest return of 86%, and some amount has to be sold here, and then you have to put them into the second stock with the lowest return, that is stock number 6, which has given a return of negative 35%. This is in contradiction to the trend following strategy. In trend following, you have to make your winners run and cut the losses, but here you are taking some profits out of the best winners and then sharing it among your poor performers, right? So this thing is not applicable when you trade in long term. Also, the capital division in this strategy might be random. For example, this 1 lakh can be divided into 10 stocks with each stock receiving an investment of 10,000, or it can be divided into 5 stocks with each stock receiving an investment of around 20,000, or your portfolio can be big by dividing 1 lakh into 20 investment, each investment receiving an amount of 5,000, and so on. So it is very random, right? So it will give rise to inconsistent returns, and it also doesn't give any importance to the risk. There is no risk component in this. Okay, so how much percent you will be losing, nothing is discussed about in this strategy. You just divide the amount into equal parts and then invest, and randomly you are rebalancing them according to the profits and losses you make. So we need another better system. So comes the third model, that is percentage risk model as per Van Tharp. So this model is somewhat better. This is the model I like the most also. I will explain in simple terms here. The percentage risk model allows us to decide the total loss or profit we will have on a percentage basis. For example, if your account value is 10 lakhs and you will be okay with a risk of 1% per trade, that means one position, then your total loss will be limited to the number of positions you take. I will explain. Don't get confused. Read it again, you will understand. So if you take just 2 positions, imagine you buy 2 stocks, okay, your total loss will be 2%, that is 1% you are risking per trade. Even if both those trades goes wrong, your total loss will be 2% of your portfolio, right? If you have taken 10 positions, your maximum loss will be 10%, even if all the trades go wrong. All trades can go wrong when you are trading in a very bad market condition. You should think of black swan events when you start trading. So this model tells you how much you can lose even if everything goes wrong. This seems better, right? So in this model, the number of shares we can buy in a position and the total money we should invest in are calculated by using the formula as shown below. The number of shares to buy equal to total risk of the entire account divided by buy price minus stop loss price. The total risk of the entire account here should be noted. It is not the risk for your position. It is the risk of your entire account. You may invest 1 lakh in a share. That doesn't matter. You should calculate the risk for your entire trading account. That is, if your trading account is 10 lakh, the total risk of 10 lakh is considered as the risk. So here the entire account is the keyword. You should note that. I will explain it in a bit with an example. So imagine the account size of a trader is 10 lakhs and he wants to risk only 1% of account value per trade. That is, he is willing to lose 10,000 per trade. So the price of the share he wants to buy is 1,000 and he decided a stop loss of about 950 rupees. So 50 rupees is the stop loss is going to 50 rupees is the risk is willing to lose. So number of shares to buy can be calculated by this formula as we discussed earlier, that is 10,000. This is the total risk he is willing to take, 1% of his entire account divided by the buy price. 1,000 rupees is the buy price and his stop loss was 950. Stop loss was 950. So 1,000 minus 950 equal to 200. So he can buy 200 shares. Even if this trade goes wrong, you will lose only 1% of the account value. So 200 into 1000 will be, that is the share price, will be 2 lakh. Totally you will be investing 2 lakh in that position. That is 20% of your portfolio. Now imagine if instead of using 950 as your stop loss, if you find a very valid stop loss at 980, then you can buy number of shares to buy equal to 10,000, that is the total risk you are taking, divided by buy price 1000 minus 980, that is the stop loss price. So you can buy 500 shares in the same trade. Okay, even you take 500 shares, you won't lose more than 1% of your account. So here 500 shares into 1000 rupees, the share price currently will be 5 lakh. So you will be investing 50% of your portfolio, when here you will investing just 20% of your portfolio. That is why your stop loss should be kept as minimal as possible to take much bigger trades. So this is the secret of big traders. They keep their stop losses little less, okay, or a little tight. Even though the share code will be there, they will be trading the highest when the trade goes right in their way. So there are a lot of mix and matches to this technique, which I will be discussing in a separate video. And so you can see in the previous scenario, we can invest only 20% of the portfolio, while here we can invest 50% of our portfolio with the same risk, that is 1% of the account, right? So there is another model which Van Tharp thinks is the best model for him. I differ from it because I will explain it later. This is percentage volatility model. Okay, what he says is, we all know that markets are always volatile, right? The stock goes up and down with the volatility. In other words, if you take the high of the candle, this is the high and this is the low. Okay, if you might subtract the high price and the low price, you get a number. Okay, this rate of change percent is called as the volatility for the day. So in a highly volatile market, if you keep your stop loss too tight, you are bound to be shaken out. Sometimes the normal movement of the stock or the volatility of the stock can shake you out, right? The percentage volatility model tries to overcome this thing, because you keep the stop loss based on the volatility of the stock and not on a arbitrary moving average or pivot. Here, instead of keeping a pivot, moving average or a certain percentage as stop loss, we take the volatility percentage of a certain period as stop loss point. For this, we use average true range indicator. I will explain in a bit. Average true range indicator is an inbuilt indicator in the TradingView app. Just go to TradingView, and in the indicator section, you can click ATR, that is average true range. There are many private community indicators also, but this works good. Average true range, normal built-in indicator is enough. And in that settings, what you are doing is you are having the length of 14. Okay, so what does, and you are having the smooth simple moving average. What it means is the volatility of the stock for the past 14 days is smoothed into a moving average. The line we are going to see here, you can see the average true range. This is the average true range line. The line you are seeing is nothing but the moving average for the past 14 days. Moving average of the volatility of the stock for the past 14 days. I will explain you with an example. This is a stallion stock. The stock gave a beautiful breakout, flag breakout quite some time back. And on the breakout day, the close was around 152.08. On the same day, you can see the ATR or the average true range on the breakout day is around 11.12. So what we do is we multiply this 11.12 with 1.5 number, an arbitrary constant number. Why we multiply it by 1.5? It means the volatility 11.12 into 1.5 is considered a normal volatility of the stock. You are multiplying it by 1.5%. So if the stock moves up and down within 16.68 rupees or the dollars, whatever it is, then it is considered normal. So stop loss point is calculated as follows: 152.08 minus 16.68 equal to 135.4. This value here, you can see this line, this is 135.4, which is around 10.97% from the time we entered into the stock at the close. I'll explain once again. The ATR value is 11.12. We multiply that 11.12 by 1.5 times because we consider 1.5 times of this volatility is normal. Even if it goes below this, then volatility is abnormal and we have to sell the stock as we consider it as our stop loss point. So here the disadvantage is or you can say also advantage, but I don't know which type of trader you are, it depends on how you feel. But for me, the 10% or 10.97% comes around 11% is the fixed stop loss. You can't make a smaller stop loss of 5% depending on hourly time frame. If you see, there will be a pivot which you can use it, or you can choose some other method to reduce your stop loss percentage, but here the stop loss percentage is fixed. So this I feel is a little disadvantage in this technique. Also, depending on that, how we will buy the shares, I will explain here. So imagine the account size is 10 lakhs for the person and he is willing to lose 1% of his account. So the number of shares to buy equal to risk of the entire account, that is 10,000, divided by buy price. Buy price is 152.08 minus 134.4. This is the stop loss amount we arrived by calculate using this principle, using this formula. 152.08 minus volatility 1.5 times 16.68 equal to 135.4. This value is considered as stop loss, right? So we are using this as the stop loss point and we can buy 600 shares. So total money to invest is around 600 shares into 152.08 equal to 91,248. In other words, you will be investing around 9.1% of your entire portfolio. Of 10 lakhs, you will be investing 91,248, that is 9.12% of your portfolio. This is how you can arrive how much shares to buy and how you can fix your stop loss using the average true range indicator. I usually don't prefer this because, as I said, the average true range indicator is a dynamic indicator and it keeps on changing daily. Okay. Also, it will be very easy for a trader like Tharp, who is a system-based trader or an algo trader, where the system will automatically instigate him to calculate the newer stop loss position daily. So I prefer the break of structure is more important. Break of pivot or break of moving averages are more important for me to exit a stock rather than thinking of the volatility. Okay. So on this method, how we will calculate the stop loss as of today. As of today means I mean trailing stop loss. Can you see here? This is the point where you took the trade, right? When you took the trade, the stop loss was decided at 10.97%, that is 135.4. After you took the trade, the stock started to perform better and it keeps on moving. Suppose today you want to keep a trailing stop loss for this. What you will do? The stock price as on recorded date is trading at 210.16 and you can see here the recorded ATR, that is average true range, for today is around 12.84. This is what it shows, right? So what you do is 12.84 into 1.5 times, that is 19.26. A movement of 19.26 price movement is considered normal for this stock as of today. So the stop loss will be calculated as current price, that is 210.16 minus 1.5 times the volatility, that is 19.26 equal to 190.9 will be your trailing stop loss. So as of today, if the stock crosses 190.9, you should exit. That is what it implies. So this keeps on changing daily. So if you are using this average true range as an stop loss triggering point or your position sizing strategy, you should calculate it daily. You can use an Excel also to calculate it daily for you. It's very simple, not that much difficult, but I believe the break of pivot is more valid than this. Okay. Sometimes it may come here, touch it and then go also. So the break of pivot or a close below this pivot point is considered much more valid to me than considering the stop loss based on ATR. So that's it for today, guys. I would like to end this video with a note that position sizing plays a very important role for consistent results in stock market. So among the strategies discussed, for me, equal value unit model and percentage model works good if used in combination. How to use this in combination, I will make a separate video on it with an Excel explanation on how to use it properly and correctly. And if possible, I will also share the Excel sheet with you in my next video or so. For traders who do algo trading, a model based on volatility, that is model 4 based on average true range, might be a good alternative. You can try that also. There is no one right method in trading. Any method will work if you work on that method. I hope this point is clear. It is important to decide the risk for the entire portfolio rather than deciding risk per trade only. This is very important. Most of the traders give very importance to the stock they invest. See, the stop loss is also important. The risk of the stock is important, but the more important is the risk of your entire account value. Position sizing might be a little difficult concept for someone like me who takes time to understand. So kindly rewatch the concepts as many times as possible till you understand it properly. Once you grasp the essence of it, it will be highly rewarding. Believe me, this one thing will improve your trading a lot. So that's it for today, guys. If you like my video, kindly consider sharing it to your friends. You can subscribe to my channel if I add value to you, and you can put it in comment section if you want any new videos or new topics to be discussed. That will also be valuable to our trading community. Thank you, guys. Bye.